Hi everyone. In today's video, we'll be discussing about the core principles of Dow theory. So Dow theory is considered as one of the most foundational concepts in technical analysis. And if you are someone who has challenges in identifying trends or when to enter or when to exit, when do you know the distribution phase has started or when the smart money is exiting, Dow theory provides a very simple framework for identifying trend identification and trend confirmation. So that's what we'll be covering in today's video. So the first principle of Dow theory is that the market discounts everything. That is, all available information is already reflected in the price of the asset. So now, the most important takeaway from this principle is that we should not be making any trades or investments based on news. This is because the insiders and the smart money like institutional investors, like big analysts, and they already know the information before the public knows. So you might have known before some surprising earnings or some surprising news about a new product or a price hike in a particular stock company, you would have seen that the stock price would have already started moving. You would have also seen when there are any government policies favoring any sectors, the sectors related stocks would have already moved up before the government announces these public policies that favor these industries. So never trade based on news because it's already factored in the stock price or the asset price. So this is one of the principles. So the next principle is that there are three types of trends. So the first trend is called as the primary trend, and the second one is called a secondary trend, and then there are minor trends. What is primary trend is? It is a major trend lasting for few months or years. So when we look at a stock price and when we view it on a time frame and we see that the stock price has been in a 45-degree angle, then we say that the primary trend is still uptrend. Now there are within the primary, when the primary trend is ongoing, there will be short term corrections or pullbacks in stock prices. These are called as secondary trends. So these are corrections that are lasting for a few weeks or to few months. So this is one of the most important things because a lot of people, investors or traders, they buy good companies, but because of these secondary trends or short term fluctuations, they fear about giving up their paper profits and then exit in the middle of the primary trend itself. And then the stock continues to make newer higher highs or higher lows, and then they will not be able to get into the stock price because they would have already think that they had this stock at a lower price and they don't want to buy it at a higher price because they are afraid of buying at a higher price. So knowing whether the primary trend is still intact will help you hold on to your winners and ride the and maximize your winners as you hold. So you might have realized that you might have bought several stocks that went on to become like multi-baggers, but you would have, I have also had this experience when I was a beginner. I would buy good companies, but because of the short-term secondary trends or short-term fluctuations or daily fluctuations, I would sell them because I was afraid of giving up the paper profits. So knowing that there are three components in a trend, like primary trend that lasts for a few months or years, and then there are secondary trends like short-term pullbacks and like minor fluctuations, like minor trends that last for a few days. So these things will help you hold on to your winning stocks for a longer time. The next core principle of Dow theory is that the Dow theory explains about the three types of phases that are involved in a trend. We already looked at the three types of trends. Now we are going to look at the three types of phases within the trend. So let's first look at what happens in a bull market. So the bull market, the first one is the accumulation phase. The accumulation phase is when the price of the asset rises along with volume. So this is when the smart money or the institutional investors tend to, they already know that the company is going to do well in future, or they know that the company is going to turn around or going to come up with new products. So they tend to accumulate these stocks, and they know that once this information is available publicly, the market will be reacting positively. So they tend to accumulate this particular asset or stock during the accumulation phase before the public participation begins. So that is the next phase. So public participation is when the retailers, just like trend traders or momentum traders, they catch hold of this trend. So when the smart money is buying into a particular asset or a stock, they tends to rise the push up the price up along with the volume. So this can be technically studied and can be found out on scanners. And then this is when the retailers tend to join in the trend and tend to further uh, push up the stock price. So this is when retailers join the trend, and this is phase is where it's called as the public participation phase. So the third phase is when the excess phase. So this is when the other common other people, like it's all over the news, and a lot of other retailers also join in the trend, and the price is really overstretched or is very far away from their mean or the median, like the stock price is very far away from these 200-day moving average. So this is the phase where the smart money tries to slowly close their positions and then start the distribution phase, which is the beginning of the bear market or a sideways trend. So just like the bull market trend, in bear market there are three types of phases. So it starts with the distribution phase. So this is when the smart money starts selling to the newer participants, the newer entrants in the market. So the smart money starts exiting or closing their positions or winding down their positions, like they sell down partial positions and then they try to reduce the exposure to this particular asset. The next one is when the public starts identifying this, that the smart money is exiting. So this is when, like retail, like we can observe this in terms of like the stock tends to make lower lows or lower highs, and then the public retail trend traders or momentum traders, they identify that the trend is reversing or the stock is losing its momentum, and then they start joining this trend by closing out their positions as well. The final phase is when the dumb money is averaging down, like this is when people think, okay, this stock went up a lot and now it's crashing down, I will buy. This is where dumb money enters, and then they keep averaging down, and then it really tests their patience, like people who chase 52-week lows or people who try to buy low like companies that are crashing. So this is when the panic is in the market. So it will really test their patience, and as a company or the stock price tends to go lower and lower until it goes to zero, it will really test their patience and it will create a panic in the market or in the stock price or the investors who are currently invested in that particular company. Now if we can draw it, or I can just show it. So in terms of bull market, so it starts with the accumulation phase, and then once there is a breakout, this is when the public starts participating, and then this is when the excess. So this is the accumulation phase. This is when the smart money tries to accumulate, and once there is a breakout, this is where the public participation begins, the trend traders or momentum traders catch hold of this public distribution phase, and this is where the excess phase, the smart money starts showing like exiting or reducing their positions. And it can move in the sideways phase, and we can start from here. This is where the distribution phase starts, and so this is the distribution phase where the smart money starts exiting, and once the stock loses its momentum or the trend reverses, the public retail traders also know that, okay, the trend has reversed or the distribution has started, they start closing out their positions. So this is the public participation phase, and this is the panic phase when the stock really crashes or the price momentum is really on the downside. So this is the panic phase, and this is the distribution phase, and this is the public participation phase. The next important component of the principle of Dow theory is the volume. Volume is a key component of trend confirmations. Whether we are an uptrend, downtrend, or a sideways trend, volume is a key component, and it's used as a confirmation component. Like rising prices should always be accompanied by rising volume. So this is why a lot of breakout traders or momentum traders also consider volume as a factor in determining if the if the trend has really started or if the phase has really started. So volume is another key component or key principle in the Dow theory. The next one is the trend reversal. Like Dow theory states that trend tend to persist until there is a clear reversal sign. So trend reversal, that is a change from one trend to another. That is the change from bull market to a sideways trend, or bull market to a bear market, or from bear market to a sideways trend and then to a bull market again. So in the short term it can be very difficult to pick, but if we use a higher time frames like a week or a months, we can be able to pick out trend reversals as it becomes, as the noise is reduced, and we can clearly tend to pick out what is the current trend. So this is why knowing the primary trend, secondary trend and minor trend is important. Yeah, this is very important. Like when we look at volume as a component, and when we use when we want to know that the trend has particularly reversed, so knowing that there might be short term corrections and the primary trend lasts for a few months or a few years, knowing that these things will help you zoom out of the picture and then identify whether we are in whether what is the primary trend, what is the secondary trend, and when does the clear trend reversal happen. So that's the reason why I say that we need to use higher time frames to find out whether we are in a primary trend or whether in a secondary trend. So most common, like beginners, they use like daily trends, like minor daily, to identify if the trend reversal has happened, and in most cases it will give us false signals. So that is the reason why we might exit our winners very early, thinking that okay, the trend has reversed. So I would always suggest you to use higher time frames when you want to find out which trend we are in, and not to rely too much on daily prices, not to make any trading or investing decisions based on just your daily trend, because the daily fluctuation is a minor trend, and we'll have to factor in primary trend and secondary trend if we want to ride the entire wave of the upswing, and if we want to make more money from our winners. Like I always say, to be successful in trading or investing, we need to have big winners and we need to have small losses. So big winners will be able to will be part of our portfolio only when we are able to ride on these primary and secondary trends. One more key component of Dow theory is that it provides a simple framework for identifying whether we are in uptrend. That is the higher highs and higher lows concept. So when the stock is making higher highs and higher lows, we tend to say that the stock is in an uptrend. So this high is higher than the previous high, and this high is higher than the previous high, and this high is higher than the previous high. So we can see that the stock is in a clear uptrend, and this low is lower than this low, and this low is lower than this low. So this is a higher low, higher highs. Yeah. So this is a very simple framework for identifying a uptrend. Similarly, in a downtrend, if the stock continues to make lower highs and lower lows, we tend to say that the stock is in a downtrend. So these are like this low is lower than this low is lower than this low. So using this simple framework, we can like if we are long a particular company, we need to be participant in that particular asset or stock only when it is making higher highs and higher lows. Similarly, if we are short something, we can be short when the company continues to make lower highs and lower lows. So this high is lower than this high is lower than this high. It means that the stock is in a lower trend, or in a downtrend. So in today's video, we looked at what is Dow theory, and if you learned something new, please do consider subscribing to this channel, and also comment what you want me to cover in the next video. Thank you for watching.